Elfreda. I'm the Client Portfolio Manager at Alphinity Investment Management. Today I have Jeff Thomson with me. He's one of the global portfolio managers, and today we will be talking around our outlook for 2026. So Jeff, we're going into a new year. Let's start top down. What are your thoughts around the macro environment and specifically for global equities into 2026?
Yeah, hi Elfreda. Look, in a word, we're relatively constructive on the outlook for macroeconomic growth. Last year, US GDP was in the order of 2%-ish. We still see that as probably the best estimate for where GDP lands this year, sort of in that 2% bracket, maybe modestly higher. The consumer remains quite resilient. There's been some weakening in the labour market, but generally speaking, the consumer has remained remarkably resilient. We think that continues. Policy is probably at the margin supportive. We've got a very easy financial conditions, credit spreads all-time lows effectively, Fed rate cuts, some marginal fiscal stimulus coming in, and a really strong AI capex cycle. So always, there can be zigs and zags. Policy remains somewhat uncertain, but our best estimate at the moment is more of the same for this year.
So quite a constructive outlook there. And let's pivot to global earnings. That's obviously one of the key cornerstones of the Alphinity investment process. So what are your thoughts around the global earnings cycle, where we're at in the cycle, and also just from a bottom-up point of view, what are you seeing as a key driver of that cycle into the new year?
Very similar to my comments on the macroeconomic cycle. In a word, the corporate earnings cycle is positive at the moment. Basically, Liberation Day last year, there was a little bit of a hiccup. Subsequently, the corporate cycle has turned positive and probably accelerated into this year. I'd probably call out 2-3 things in terms of earnings breadth or earnings diffusion. That's broadened out quite a lot and reaching sort of 3-4 year highs in terms of the models we're looking at. Analysts are revising up the consensus estimates. So the last 3 months, on average, analysts have moved estimates up by sort of an order of 2% plus on pretty much most time frames, led within financials and technology, but some signs are broadening out across sectors. Materials has turned positive more recently with commodity prices, and there's some evidence that even beyond that, there's strength. And then if you look at the absolute expectations in terms of earnings growth, so for the MSCI World this year, earnings growth will be in the order of 10%, maybe a little bit higher even as we report fourth quarter earnings, but accelerating to about 13% for this year. So, broadly speaking, the earnings cycle really, really positive and a big reason why we remain relatively constructive on the outlook for earnings. I think probably if there's one thing to be very mindful about is valuations. Obviously, valuations on pretty much any measure you look at are at or close to historic highs. That's going to be a headwind to absolute performance, no question. But broadly speaking, we really focusing on that earnings part of the equation, which we remain as a positive. We think that helps markets. And again, look, there's going to be zigs and zags. Even in a good year like last year, you saw quite significant moves in the market. So I think one has to just be prepared for some volatility.
Definitely, if the first few days of January is anything to go by. So let's pivot and talk around another really important factor for the Alphinity process, and that is quality. In your latest monthly, you do talk around what happened to quality last year. Can you give us a bit more background, and then also what do you think of the factor into 2026?
Yeah. Quality is a cornerstone of how we invest at Alphinity. It's a very consistent, very reliable driver of investment performance over many decades. Last year was really quite notable and in terms of being a very significant period of underperformance for that particular investment factor. It's hard to put your finger on any one driver of why that happened. I think there are a couple of things perhaps at play. One is obviously maybe in hindsight some relatively elevated valuations for some of those stocks going into that period. But if you look at the sectors, it's really interesting. Consumer staples, healthcare, software stocks, obviously all over-indexed in terms of quality, all had some quite significant challenges, I think, through last year. And on the flip side, some sectors that don't perhaps aren't included in quality. So banks, for example, Japanese banks, European banks, miners, all performed really strongly. So I think the result of that, you saw a really significant drawdown in that factor. But we remain really confident that that's a very reliable mean reverting factor. By definition, these companies that are deemed quality are in really great industries, wide competitive moats, great management teams that have got long track records, and we continue to be really quite optimistic that mean reverts over a period of time, I think, going through this year and into next.
And let's put all of that together. So we're talking around a constructive macro backdrop, positive outlook for the global earnings cycle, and then hopefully the quality factor coming back into vogue. How are you positioned across your global portfolios for the new year and against all of that?
Yeah, look, I think the two things probably to say here is, one is, as you'd expect us to be, we are fully invested, aligned with that earnings leadership, that leadership, and that's both by sector and by geography. So, I've already talked about technology and financials, key parts of that earnings leadership. We remain really well invested there, stocks and technology like Alphinity, TSMC, Tencent, and then in the financials, we have European banks, we have Morgan Stanley in the US. So again, those two parts of the market are really well invested. But the second thing I'd say is, we are diversified. We're always looking for that diversification, both across sector and regions. So, again, we are actively looking and finding ideas outside of those areas. So stocks like Boston Scientific, a healthcare company, has just come into the portfolio. We think that's an exciting new idea, a company potentially at the start of a really quite exciting earnings cycle. Adding to stocks in Asia, I mentioned Tencent and TSMC. Europe is also quite well, we have L'Oreal in the portfolio, AstraZeneca, so really diversified and really looking for those opportunities around earnings leadership.
Fantastic. So thank you, Jeff, and we wish all our clients a fantastic 2026. Thank you for listening, and please visit us on alphinity.com.au. Thanks.
Thank you.